business newspaper, has sometimes such a kind of biased views of things. I mean, it really irritated me, but yeah, anyway, I'm only a single person, I won't be able to stop it. And also certainly, I won't be able to fight against the big money of the hedge funds, which are now trying to prevent what is going on here in Brussels. Anyway, but that's part, let's say, of what I wanted to tell you, let's say, kind of in about 15 minutes. What we see now, I mean, if you look at 2 years financial crisis started not with Lehman Brothers, it started 2 years ago, in August 2007. You had some spillovers from Bear Stearns, had 2 hedge funds which were closed in June, July 2007. Then the shortage in the markets grew. All of a sudden, the ECB gave extra liquidity to the markets on the 9th of August 2007. And then you had about this first year of the financial crisis between August 2007 and September 2008, where already many signs were clear that there was a problem. Europe was incapable to react. There was no willingness to react. It took, in fact, Lehman Brothers and the whole disaster afterwards for what happened in the banking sector to have a real reaction, which, in fact, let's say, is on the one hand a whole regulatory agenda, which is linked to the G20, but also to imperfections in the European framework, and also an institutional framework. What I will be speaking most about today is the second part, which I think is the most important one, is this new institutional framework, where you have, on the one hand, this European Systemic Risk Council or Systemic Risk Board. So we will try to control systemic risk. Parallel with what you have in the United States, you know, also discussing something like a Financial Services Oversight Council, which will also have a kind of the duty to look after systemic risk. Below that, what we'll do in Europe is try to integrate or two fragmented supervisory system. In a European system of financial supervisors, we are creating authorities at European level with the supervisory task. Entirely unprecedented and even not fully in line with what some could argue with the EU treaty, because the EU treaty is about rule-making, about creating a single market, but supervisory powers are in principle not with the EU. So it could still be contested, although there is a broad consensus about it. But this, I think, let's say, is a big structural change, a kind of a paradigm shift which we see at European level, which you need to be aware of, because I think it will, within 2 or 3 years, we will have kind of 3 important authorities at European level: a banking authority, securities markets authority, an insurance authority, which will rapidly employ 100 to 150 people, and which will become a force in the markets, trying to coordinate supervision in Europe. But I will come back to that in a moment. So first, you see it on the slides, I said the regulatory side you have, but I could probably put it that way as well. You have action on prudential side, conduct side, and product regulation side. Let's say this is, I mean, kind of in a nutshell, what forms of regulation you have. Let's say what they are discussing today. Prudential regulation is essentially the Basel standards, which they were also discussing this weekend in the St. Andrews G20 meeting of finance ministers. The Basel rules are the rules by which you regulate capital of banks, which are a bit under discussion at the moment. Some other things are part of that, also the accounting rules, which are also discussed this weekend, by the way. There's conduct regulation, I mean, what bankers can do. For example, the remuneration, a very trendy issue today, very difficult to regulate, I think. Transparency, big issue today. I mean, everybody speaks about it, but nobody knows exactly how to do it. And then you have a product regulation, of which hedge funds is an element. You regulate a specific financial product. These are the things which we were doing. Yeah, you have other elements, mortgage loans, private equity. So these are, in fact, in these 3 blocks, the EU is working today with different forms of regulation. Probably also to explain a bit, let's say, how this interaction works with the EU, the international level, and the local level, which you see on this chart. I said a moment ago, let's say you have the EU is in charge of regulation. The EU's task is to create a single market. So it's adopting rules, like, for example, the hedge funds directive, to make sure that a hedge fund which is licensed in one member state can be sold all over. That's its mandate. Supervision, in principle, is not a task of the EU. Supervision is a task of the member states. But what have we seen in this crisis? That in fact, what we expected was in place. Cooperation between supervisors didn't sufficiently exist. Say, like, for example, the cases which happened in Belgium, Fortis, the most, I think, best known case, was an example of how it should not be done. I mean, in the Fortis case, there was no cooperation between supervisory authorities. We had this model, which they want now to beef up, of colleges of supervisors. We have multinational banks, which are supervised by a college of supervisory authorities. So all the supervisors representing all the different countries where the bank is active are sitting around the table. In the case of Fortis, all the kind of the stories have been in the Belgian media. In principle, they were to work together. Belgium has tried to solve the Fortis problem in the kind of dramatic weekend of the 27th and 28th of September last year on itself, and called upon the Dutch and the Luxembourgers on the Sunday at noon, when they were already meeting since the Friday at noon. So it took them 48 hours to work effectively as a college. And there were all things on paper which said, let's say, you need to do this, you need to do that. In crisis circumstances, it didn't work at all. Let's say they had memorandum of understanding, it didn't work. That's probably the best kind of example, but there are many others like this. Take another case, for example, I think the most flagrant case of non-cooperation between supervisory authorities, and the one which is suffering most of it today is probably Ireland. Ireland was the place where many of these kind of special entities were based. So German banks had special, what they called SPVs, special purpose vehicles, kind of entities which invested in, for example, these CDOs in the United States. They were based in Ireland. But the German supervisors were hardly aware about what was going on in Ireland. And what you see now is that plenty of banks, not only in Germany, also in Belgium, also in Denmark, also in the Netherlands, have lost enormous amount of money in Ireland because they were hardly aware about what was going on there. But also because they probably didn't do their job sufficiently to look at what are all the exposures of the bank in question. They had a kind of a narrow view from their domestic point of view, national point of view, rather than looking at it from a kind of a broader European view and doing effectively, putting all the strings and say, what is the total kind of the risk exposure of the bank in question? And in fact, let's say plenty of banks lost billions in Ireland because Ireland thought we will do it, play the regulatory competition game, we will attract plenty of business, like also Luxembourg was doing probably more in the past than today. But in the meantime, they didn't do their job properly. Let's say they said, look, a bank said, can I issue an SPV here? Boom. The next day it was done, without really asking more details. And in the meantime, let's say, then you see also the trouble Ireland is in today. It was more, I think, a symptom of an overall economy which was far too loosely run, with far too little control. So as a result of that, let's say, of all these kind of examples which I mentioned, let's say, what have we now decided? You also know that it took Europe some time to react. I would say between the Fortis crisis and mid of October, Europe was accused to be kind of passive, silent. I was called by many of you, journalists who were calling us all the time in this period last year, why is Barroso not reacting? Why is Barroso not speaking? Then by the middle of October, I mean, there was this famous Eurogroup meeting on the 12th of October, and then Barroso created this, in fact, with, I think, strong cooperation with the French, this de la Rosière group, which in fact was the start of this process by which they said, look, we need to learn from this crisis and we need to propose structural change. And that's in fact, let's say, what is today on the table of the finance ministers is the result of this whole process. So we will now create, in fact, 4 new institutions, a systemic risk board on top, run by the central banks, in fact, and then these 3 new authorities, which I mentioned already below. Systemic Risk Council is important to know, let's say, yeah, it's on my next slide, but it's consultative only. It will be staffed by the ECB, but it will not have a formal role, whereas the 3 authorities below become authorities with legal personality. So in the past, we had what I had in this previous chart. In the middle, at the bottom, you had these committees, which were called SEP, CESAR, CHEOPS, of which you may have heard. These were only committees with a consultative role. Now, what are we doing? We are creating authorities with legal personality to make sure that supervision and this cooperation between supervisory authorities and the EU effectively functions. And in fact, these bodies will become the functional European supervisors or the European form of an FSA structure over time in the next 5 to 10 years. But what the Commission has now done, and the proposals are on the table now, they were